A student, for instance, will have different objectives from a pensioner. So they will have different timelines, different risk tolerance, and different goals. As outlined, the idea is to generate returns over time. If you are a pensioner, it's in the short run. If you are a student, you're still young, time is in your favor. So you have more time for your investments to generate returns. And of course, as we said, everyone has his own objectives. For example, parents with kids, they might have an objective of investing in order to have a sum of money for education of their kids, for instance. So there are multiple objectives, and since there are multiple objectives and multiple people with different ideas, you have to tailor your investments according to your needs and wants. Main asset classes, these are the types of investments, the main ones, because there might be others. For example, here we did not list art. There are people who are experts in investing in art and other valuables because they understand that they will appreciate in value. But these six are the most common. So the first one, we have cash. Cash, not as such an investment, but within an investment portfolio, a portfolio manager usually allocate part of the portfolio in cash. So in case there is a market decline, the portfolio manager or the investor will be able to invest at a lower price following the market decline. And cash is the least risky because cash doesn't fluctuate. €1 or $1 or 1 yen or 1 sterling remains one, but the downside is that it doesn't increase in value, of course. The second one, these are bonds, and they are called also fixed income securities. Basically, bonds, there we can give an example of United States treasuries here. So the government of the United States will issue a treasury bond. It will pay, let's say, 5% for 10 years, and the investor will invest, let's say, 100,000. I'm inventing here, it's hypothetical. He will buy 100,000 worth of US treasuries, and every year he will receive 5% on that 100,000. And after 10 years, the bond will mature. And in addition to the yearly coupon, we call it, to the yearly interest, the investor will receive the full 100,000 in case the issuer does not default on the payment. Because there are instances where some countries or companies will default. We can mention Argentina, Venezuela, and others who have defaulted on their debt. The third one, here, it's stock, or they are also known as equities. Basically, an investor can buy, they are also known as shares. An investor can buy shares, let's say, of Microsoft or Apple or Google or Amazon or Facebook. And the idea here, let's say an investor invested 10,000 in Microsoft shares. An investor would choose a company which he believes that the company will do well in the future, and he would buy it now at a relatively cheaper price, at an undervalued price, with the expectation that in the future the share price will be worth more. In the meantime, some companies every year they can declare a dividend. It's not compulsory, but this is an extra amount which an investor can get returned. So in stocks, an investor can get returned by capital appreciation, where the share price will increase, or by dividends. In case of bonds, the second step, the investor gets return in terms of interest. He can also get return in terms of capital appreciation, but he would have to sell before maturity in case of bond. The fourth one is real estate. So real estate, you can buy them in the form of shares as well, and you can buy them in the form of physical property. The fifth are commodities. So commodities usually are classified into these three: the precious metals, energy, and agriculture. And these tend to be very volatile. You can generate return on them, but from my experience, it's more difficult to understand where the price is going. Usually they increase in value, for instance, when there is a shortage or when there is a war. Let's say energy prices, if there is a war or a shortage, they tend to increase in price in the short term, at least, because in the long term, it's very difficult to know where the price is going. And the last one are cryptocurrencies. Probably you heard of these. These are quite new asset class. Um, since they are quite new, it's also a little bit more difficult to understand their intrinsic value. They generate usually high return, but they have a high level of risk. So it's not easy to stomach the volatility because they can easily increase, for example, in a short span of time, 50% or decrease 50%. So if you have 100,000 invested and one day it goes down 50%, you lose half of your money invested. So although they are high return, they are very highly risky and for sure not suitable for all investors. So how do we access investments now? So we can access investments. The first one here, I'm mentioning when you buy a direct individual asset. So you can buy a direct bond, as we mentioned. We can buy a bond of the United States of America. So you can buy that individual asset, or you can buy Microsoft share. So that this box is showing that you can have exposure 100% to any one individual asset. And for example, if you want to buy Microsoft shares, you have to open a brokerage account, fund the account, do a buy trade with the amount of shares you would want to buy, and then the broker will execute um, that that transaction on the stock exchange, and you would receive a contract. So this is how you buy a direct individual asset. And when you buy individual assets, of course, you have more risk because you are just buying one entity or one company. In this case, for example, here I mentioned exchange traded funds and mutual funds. These are both funds. However, they have a little bit difference between them. But being a fund, when an investor puts puts money and buys an exchange traded fund, for example, buying the S&P 500, you are not buying just one company. You are buying a basket of companies. So the S&P 500, for instance, which track the largest 500 companies in America, by definition, if you put 100,000 in that fund, the 100,000 will be divided between 500 companies, not equally, because it's not equally weighted. The the investment, it will be according to the market size, but at least you have much more diversification, which means you have less concentration to any one company. And exchange traded funds, as we said, they are similar to mutual funds. However, as the name implies, they trade on a stock exchange. And they are much cheaper than mutual funds because exchange traded funds, they just mimic a benchmark, while mutual funds, there will be a portfolio manager, a human being managing your assets. So here, the process is much more expensive because the portfolio manager is doing research. What is contradicting here is that someone who is not in the industry of investments, they would think that since mutual funds have an individual, a human being doing the research and um, basically doing the trades on behalf of the investor, they would think that mutual funds should outperform exchange traded funds. But according to research, 80% of exchange traded funds usually outperform mutual funds. So from mutual funds, only the top 20% do better than exchange traded funds. And it's difficult to beforehand which mutual funds are likely to outperform. So from my experience, and I'm a portfolio manager basically, from my experience, exchange traded funds are the best way to go because you have the advantage of saving fees. Yes, key points about mutual funds and ETFs, exchange traded funds. You have instant diversification because with one investment vehicle, you are exposed to a variety of investments, and mutual funds are actively managed, meaning that you have a human being, portfolio manager, is actively managing the investment, while exchange traded funds are passively managed. There is a computer process which sets a benchmark, basically. So investment strategies. There are a lot of investment strategies, but these are an example, just four of them. So basically, there is long-term investing, buy and hold. So an investor would invest, let's say he buys the S&P 500, it's a fund of the largest 500 companies in the United States, and doesn't do trades. Basically, he just buys either a lump sum, usually a lump sum, and leaves the amount there to compound returns. So that's long-term investing. From my experience, long-term investing is one of the best to do because there is a tendency for investors when, for example, when there is a down market, some investors try to time the market and they end up selling low, for example, and realizing losses. So the best thing is to remove your emotions and keep your money invested. There is a saying to have more time in the market as opposed to market timing. So market timing is not good, but time in the market is very good because in the long run, compounding of returns makes a huge difference. The second one is trading. Trading is the opposite of long-term investing. It's very short-term and it's very difficult also to do because usually it's more technical analysis. So technical analysis. So the first one is fundamental analysis. You are studying the balance sheet, for example, of a company. You are studying numbers. Whereas the second one, technical analysis, you are studying patterns and charts. So from my experience, it's much more difficult. And in fact, there is, according to research, there is this rule, that the 90-90 rule, that 90% of the traders within the first 90 days, so within 3 months, they lose 90% of their investment. So it's very difficult to generate good returns in this. There are people who are good in this, but the odds are against you, basically. The third one is dollar cost averaging. I'm a fan of this because basically this entails in investing every month part of your salary, part of your monthly income. And when you automate this, you are removing emotions and you are buying at different time intervals. So sometimes you are buying low, sometimes you are buying high, sometimes you are buying low again. So by having dollar cost averaging, you are not you didn't go in with a lump sum at one point and the market can go down and turn against you, which might happen. With dollar cost averaging, you are doing it every month. And from my experience, you tend to follow the, to stay the course. And also you tend to ignore if ignore to the extent ignore less if the market goes down because you're still investing every month. In fact, it's better if the market goes down because you will continue investing every month at a lower price. And you want the market to go up before you access your money, basically. So when you withdraw your money, you withdraw at a high price. The last point is accumulator versus income investing. So accumulator simply means that if you receive an interest or a dividend, that amount is automatically reinvested in the fund. So someone who started working who's still young, usually, and he doesn't need the money, in order to grow his wealth, he will go for accumulator because you will benefit from compounding returns as well. However, a pensioner who has saved all his life has a good lump sum. Let's say he managed to save 1 million, including the returns generated. So at 60, 65, he has 1 million, and this pensioner wants extra income to supplement his pension. So he will invest it, let's say, at 5%, and he will get 50,000 in interest per year. So that is the difference between accumulator and income. So what is strategic investing? These are the key principles of strategic investing. So strategic investing essentially is investing with a scope, with an objective in mind. Because, for instance, from my experience, there are some people who just buy, for example, Tesla stock without doing the research or any other stock, not Tesla only, or buy Bitcoin, whatever, without any strategy. It's important, especially when you invest substantial amount of monies. That you have a plan, that you have a strategy. That is what strategic investing is. Okay, the idea is fluid here because everyone has his own strategies, his own objectives, his own needs, his own demands. But at least you have to sit down with yourself and ask some questions to yourself before you start investing. So the goal setting, as we mentioned, if you compare a pensioner with a young adult, they will have different objectives. So a pensioner cannot, wouldn't usually go for Bitcoin or wouldn't usually invest 100% in stock. Usually, I'm saying usually because there is always exception to the rule. There are some people who, for example, a portfolio manager who is a pensioner, who is willing, he has the knowledge, he has the experience, and he prefers having 100% in stock. So for that kind of individual, that's fine. But usually, a pensioner will be more defensive in while a young adult is more adventurous. He can take more risk because time is in his favor. Asset allocation. By asset allocation, we mean that the best way to have a portfolio is to have different assets. So let me just go back to this slide. These are the different asset classes. By combining different asset classes, usually portfolios made up of stocks, bond, cash. Now some are also including crypto, not everyone because it's quite risky. And commodities, there are instances where it is included as well. So that is asset allocation, including different assets. So you do not invest just in stock. You have different asset classes. Another principle of strategic investing is the risk management. So if someone cannot stomach volatility of the stock market, of course, he cannot go 100% into stocks. He has to include an asset class, which is more defensive, like bonds or cash, basically. But also, not all, for example, not all stocks are the same. There are some stocks which are called growth stocks, which tend to be high risk, high return. And there are some other stocks which are value stocks, which fluctuate much less and give dividends on a regular basis. So basically, you have to go in details. You cannot just rule out that all stocks are the same, basically. And risk return trade-off. Of course, higher returns come with higher risk and vice versa. Lower returns come with lower risk. And this is the idea of strategic investing. Of course, diversification plays a major role in strategic investing. Diversification is one of the most, if not the most, important concept in finance. So if you have 100,000 to invest or 10,000, whatever, it makes sense not to put all your eggs in one basket, as this Spanish novel said. This is from Don Quixote. It was written in 1605, and he wasn't referring to investment as such, but it's the same concept. Don't put all your eggs in one basket. If you have 100,000 to invest, do not buy one one company. Do not buy Apple only or Microsoft only or Facebook. Do not buy one company, but try to find an ETF or a mutual fund. An ETF is better, but if you cannot find one, for example, in your country, maybe you don't have access and you can invest in mutual funds, that is fine. At least you have a fund which is diversified, because if you invest in one single company, the risk is very high because you have concentration risk. And there are a number of risks. The company, if, for example, let's say you invest in Tesla only. The company might not default, but there is market risk, the price of the stock. So in few years or even months, sometimes some stocks can go down 30 to 50% easy. So if you have a good sum of money, which you work hard for it, you shouldn't put it in one company, because that's very, very risky. And this is the concept of diversification, to spread the capital the investment, our 10,000, our amount to invest, whatever, between the so I have this question before we proceed to the next slides. Here we have two assets. So we have asset A, this is asset A, and this is asset B. And the question here it is telling us which asset would a rational investor choose between asset A and asset B. I will give you some seconds to think about it, and then I will provide you with the reply. This is for some probably it's easy and straightforward, but it is the basic of the portfolio optimization of the quantitative model that we are going to do later in the session. So basically, I hope that you have thought about it. Basically here, just to explain, asset A has 10% return, expected return, and asset B also has expected return of 10%. So in terms of return, they are generating the same. But in terms of volatility, and by volatility, we measure this by standard deviation in Excel, which measures basically the deviation from the mean and is a proxy for risk. So asset A has a risk of 14%, an annualized volatility of 14, while asset B has a risk of 17%. So a rational investor will always choose asset A because for the same return, he is exposed to less risk. So portfolio optimization. The idea in portfolio optimization is to continue on the previous slide, to do a portfolio which will provide the highest possible return, the highest attainable return at the lowest possible risk. In finance, this concept is called the Sharpe ratio or risk-adjusted returns because the Sharpe ratio is a measure of risk-adjusted return. So an investor is an investor who wants to implement strategic investing should be concerned not only with expected return, with risk-adjusted return. You have to include risk into the equation. And in finance, we call there was a paper by Markowitz. It's called Modern Portfolio Theory. It's quite old now, but we still call it Modern Portfolio Theory. It was in the 1960s. So probably we need to change the way we call it. It's not modern anymore. But it's a very important paper, and it showed how to do mean variance analysis. And in this session, we are going to do this analysis. I am going to show you in Excel. We will pick for assets, basically, and we will perform portfolio optimization. And the idea in portfolio optimization, as we said, is to always balance risk and return. And we will be able to do it in Excel by using the data solver function, as we are going to see. So, efficient frontier. What is the efficient frontier? The efficient frontier basically is a representation of, is a graphical representation in this case, of the different pot here, where these are basically different portfolios from where an investor can choose. Of course, you want an efficient portfolio. That's why it's efficient frontier. You want portfolios which are located on this curve outside. That's the efficient frontier. Because portfolios, as we checked, as we discussed in this slide, this is efficient and this is inefficient, although they have the same return. This one, a rational investor would ignore it because it has a higher risk. So likewise, in the efficient frontier here, we only choose we only choose positions, stocks, portfolios better, which are on the efficient frontier. Points which are outside, they are inefficient. A rational investor would ignore um, such portfolios. It doesn't make sense. For instance, let me give you an example from here. Here, let's say this spot, somewhere here, is generating expected return of 10%. And the volatility is around 12.5. Let's take another spot, an extreme one, to understand the example. This one is also 10% return, but the volatility is more than 20%. So that's the one here, it's inefficient. A rational investor would never choose that. So what we are going to do now, I'm going to open an Excel to show how we can do portfolio optimization and how we can generate the efficient frontier. In the meantime, if you have any questions, please let me know. So what I did, the first step, I downloaded the prices for sample ETFs. These are just an example. You can include as many investments as you wish. And here I only chose equity. I only chose shares, stock, ETFs. Okay, it's a fund, but the asset class, it's only made up of shares. So in practice, the more investments you would include, the better representation you would have. For example, in the presentation, there is the QQQ is the representation of stock. The second one, SPY also stocks. The this one TLT, it's bonds. VTI is bond as well. So if I recall correctly, so here this efficient frontier is showing different, has different asset allocation, not just stock. But for our example, it, I mean here we want to show how to do portfolio optimization. That's the most important thing. So the first step is to download the prices. I downloaded prices for these four investments from 1st January 14 till March this year. The first one, I always take a previous day because in the next sheet, we would need to do the percentage change. So basically, we would lose one if we do not include this one. So let us proceed. So here we will do the returns. I remove this one. Here what we need is the percentage change. So essentially we can just do new minus old division by old. And we have the percentage change. But those of you who studied statistics, the best way to do the percentage change is to incorporate logarithms, logs. Because when we incorporate logs, the percentage change, this result that we will obtain here, it will be following a normal distribution, a bell curve. So for us, especially not only in investments, but in investments, we try to obtain data which is normally distributed, essentially. So we would do ln, we go prices sheet, division, and that's it. And we do the percentage change of the first sheet. That's the first step. Then we would want to calculate the daily average return, daily average volatility, the Sharpe ratio, and then we would need to annualize the return, annualize volatility, and we do the annualized Sharpe. So basically here, what we are going to do is a simple average of the returns of the change, percentage change, and that's a simple average. Then for the volatility, we would need to do standard deviation of the same column, and the Sharpe ratio, we can simply do like this. The correct Sharpe ratio, usually you have to deduct the treasury, the treasury rate. But in this case, I mean, I can remove the treasury rate from all from all columns, so it won't affect us in this case. So to keep it simple, we can proceed like that. Now we have to annualize. So basically, by annualizing, we have to take the daily average return and do it yearly. So what we need to do is basically take this amount, power it up to, to 60 trading days, because the stock exchange opens roughly to 60 days during a year. And that is the annualized return for the first one, for the Nikkei, which is the Nikkei is basically a benchmark of the largest 2 to 5 Japanese companies. That's the Nikkei. The S&P, we outlined it. It's a benchmark of the largest 500 companies in the United States. The FTSE 100 is a representation of the top 100 companies in the UK, and Euro Stoxx represent the largest 50 companies in Europe. Now, annualized volatility. Annualized volatility, what we have to do, we take the daily average volatility, we square root, and we do 260 trading days as well. and the Sharpe ratio as usual. So basically, this data is showing us that the first asset, the Nikkei, during this time horizon generated 10% per year with a volatility of 19%. And also we have the returns for the others as well. So we have the return already calculated here along with the volatility. The next step is to do the excess returns. Excess returns. This might look as the boring part. I understand. We only have um, another sheet after this to do, but then these are very important because we need them in order to do the portfolio optimization, which is, in my view, the most interesting part of this session. So the excess returns, basically what we are going to do, we are going to take the percentage change and deduct the daily average return, which we calculated previously. And what I'm going to do, I'm going to do a dollar sign here to fix the cell. So when I drag everything exactly. So that's the excess returns. The next one is the matrices. So in the matrices, we need to do this data. I will show you. I will get this data from a sheet which we already worked on. And I'm going to do transpose because in the sheet, they were horizontal and now I need them vertical. So that's what the transpose does. Going to take these and do them like this. So that's it. Then I'm going to do sample size here. And all I need is a count basically, the count formula. It will count the number of values that we have. So I can go here to the returns. So we have 2658. Now I'm going to do the matrices. We can start with the excess returns matrix. And since we have 4 assets, I do like this. And basically the excess return matrix, the formula might look a little bit complicated, but essentially here, what we are going to do is go to the excess return matrix, excess returns sheet, and multiply it with itself. So that's all what we are going to do. So I'm going to do matrix multiplication, transpose. We have to do transpose because, as probably some of you know, in math, when you do matrices, you can multiply a, a column with a row. You cannot multiply two columns together or two rows together. So one has to be a column and one has to be a row, essentially. So we go to the excess returns. close brackets, and then we select the same one. And that's the excess returns matrix. When you do matrix, when I'm doing this formula, this is very important. You do not just press enter, because if you press enter, it will give you an error. So instead of pressing enter, you have to press Control Shift Enter. So you press Control Shift Enter, and it will work it out for you. Because if you just press enter, like when doing a normal formula, it will give you an error. So the next one is the variance covariance. I know that this part looks like statistics, but we will soon be into the part where we will be doing um, strategic investment part, basically. But we need the statistic in order to have robust results. So the variance covariance, all we need to do is taking the excess returns matrix that we just calculated and divide it by the sample size. And again, look, if I press enter, you will have an error if I just press enter. So what you have to do, you have to press Control Shift Enter, not to have errors when doing matrices. So that's the variance covariance. The next one is the standard deviation matrix. We're soon ready from this part. And the standard deviation matrix, all we need to do is multiply the volatility with itself. So matrix multiplication transpose and that's the standard deviation matrix. So the last matrix, the correlation matrix, show assets with each other. And correlation matrix is simply the variance covariance divided by the standard deviation matrix. A point to note here is that the correlation matrix will show you when you're doing this process whether you are on the right track, whether you're working correctly. An asset with itself always has a correlation of 1. If this is not 1, you have something wrong in the workings. This is basically the normal correlation. Correlation, for example, if you have two assets and asset A, basically you're asking, when asset A goes up 10%, asset B, where is the direction of asset B? If when asset A goes up 10%, asset B also goes up 10% the same. They have a correlation of 1. We call it positive correlation. If when asset A goes up 10% and asset B goes perfectly exactly in the other direction, it will be -1. So that's, I'm sure you have heard of correlation, how things move together. In this case, how investments move together. And in investments, it's important to have assets which have low correlation, because you do not want assets to move together, because when the market goes down, if your if all your assets are correlated, all of them will go into one direction. Basically, if they are correlated with the market, they will go down. So you need a low correlation between your assets. So the next sheet, here starts the interesting part, in my view, the portfolio sheet. And I'm going to list the assets I list the name, excuse me. So here I'm going to list the names. Then let's say here I will create an equally weighted portfolio. You can also do minimum minimum volatility and maximum Sharpe. I will explain what these are. And let's say we want an equally weighted portfolio to start. Now, what I need to do is take again daily average return and daily average volatility, and also take these. So basically now, previously, what we did when we did the daily average return and annualized, we did them only individually, separately for the individual assets. Now we want this calculation portfolio according to the weights that we give over here. So what we need to do here is matrix multiplication, transpose. I take the weights, then I go to the matrices and take the daily average return from here. And that's the daily average return of this portfolio. Then we do the volatility. So the volatility, what we need to do, this can look a little bit complicated, but once you have the formula and you do it a couple of times, you will understand better what we're doing. So in order to work the volatility, we take the weight of the individual asset, then go to the matrices and go into the variance covariance. And go again into the portfolio and take. And that's the daily average volatility. And then, of course, we have to annualize again. In order to annualize, this is very easy. We take the amount to the power up to 60 trading days. That's the annualized return. And the annualized volatility. So like this, we have the return of these assets if they are equally weighted. Of course, if we change, let's say we do the first one 20 and the second one 30, for instance, the return will change according to the weights that we write here. Now I'm going to include also some statistic, the value at risk, essentially, because it will help us to understand better the maximum drawdown of the portfolio. And after this, we will start using the solver to do portfolio optimization. So the debt score, this statistic is found in the distribution tables. It's at the 99% confidence interval. Portfolio value, we can do 100,000 portfolio. This is just an example. Time frame, we can do yearly. And in order to calculate the value at risk, we can do if statement. So this is the maximum drawdown within a year. So this statistic is telling us if an investor invests equally weighted into these four, the maximum expected loss should not exceed 32,000, which in percentage terms, it's 32, 33%. Okay, so now we can move to portfolio optimization. Finally, what I need to check here is to include the dollar sign so that when we drag, we won't have any issues. That's one. And the other one is here. Now we can drag. Okay. Now what I'm going to do, I'm going to open the solver in Excel because, of course, these weights are for the equally weighted. They are not for the minimum volatility and maximum Sharpe. So we go to data and we go to solver. If you cannot find it, because sometimes it's not enabled, you have to go to options, add-ins, I believe Excel add-ins, and solver. Mine is tick. And you have to enable it from here, basically. So what we need to do here is the following. This objective is minimum volatility. So I'm going to select minimum objective. I'm going to select annualized volatility. So minimum and select this one, annualized volatility. By changing variable cells, by changing the weights of my investments. And the constraint is that the total of the investments has to be equal to 100%. And OK, and I can press solve. Once the process is ready, take a look at this part here, because the solver will change the weights of the investments according to the constraint that we are giving him here. In this case, minimum volatility might be a good portfolio for a pensioner, for example. It all depends on the objective and on the constraint that we are giving the solver to do here. So solve, it can take some few seconds to solve it. That's normal, because in the meantime, it's calculating mathematically with percentages, make sense in order to obtain the lowest possible volatility. That's the most important here, not the return. To obtain the lowest possible volatility. Here it is small, but maybe it is visible. The solver is doing trial solutions. So it's calculating how minimum volatility can be reached. Of course, the more assets that you have, calculate it, okay. The more assets that you have, the more time it will take for the processor to compute. So it's complete, and the solver changed. The solver changed from equally weighted to this. So the solver is telling us that, listen, with these four investments that you gave me, the lowest possible volatility, and I cannot give you a better portfolio than the 30% in the Nikkei, 30% in the S&P, and 40% in the FTSE. And the volatility is 13.8%. The value at risk declined a bit as well. Not too much, it didn't decline too much, because, as we said, our investments are all stocks. But if you have a diverse list of investments, you have bonds, for example, um, along with stocks and commodities, you will see some interesting results. But here, the idea, I try to keep it simple so that we can understand how to do the optimization. Then you can experiment with how many assets you like. The process remains the same, essentially. Now, we move to the maximum Sharpe. So the maximum Sharpe, the idea is to generate the higher return for asset risk. So generate the highest risk-adjusted return. And this will be given to us by having the highest Sharpe ratio, basically. So what we are going to do this time, reset the solver, maximize the Sharpe by changing the weights, and the weights have to equal 100%. And we can solve. As we said, in finance, a rational investor will always try to maximum risk-adjusted return, the maximum Sharpe in this case, because it doesn't make sense for an investor to go for another investment which has the same return but higher risk. So a rational investor always chooses a portfolio where risk-adjusted return is high, basically. And in the meantime, the solver is computing. And of course, if you look at column D, row 15, the Sharpe ratio has to increase because that's the idea over here. We are asking the solver, listen, give us a portfolio which increases the Sharpe ratio. And in fact, it increased to 0.8. So with this set of assets, the highest Sharpe ratio is 0.8. And it can be obtained by investing 38% in the Nikkei and 62% in the S&P 500. And it will give us a return of 11.5 yearly annualized return and volatility of 14%, 14.3. So that's the maximum Sharpe. And that's the portfolio optimization. Now, for the last part, I would like to show you how we can do this efficient frontier with this data. So we can continue on the Excel. So we are going to use the data obtained here. So now what we need to do, rand array. We are going to use this formula. It's called rand array. And since we have 4 assets, we do 1, 4. If you have any questions, please stop me. I will be more than happy to explain again or clarify something. So I did rand array. You will understand better why I need this. So random weights now. Random. And I'm going to do and with it. And we have the random weight. What I'm going to do now, I'm going to drag and this part, every time you press F9, I believe, if you can look closely, it will change, but that's fine. It will change and the Excel is giving us random weight. Now, in the meantime, I would want to do the portfolios again here. I will do portfolio risk return and Sharpe, and I will copy. I will copy these here, and we can also include the maximum Sharpe and the minimum volatility now. And so I can take the risk and do transpose. That's the risk. Transpose of the return. I'm just copying. I'm not doing anything special here. I'm just, instead of doing copying and pasting, basically. But since I need them vertically, in this case, I can divide. Okay, and for the maximum sharp annualized return, and annualized volatility, so we have the table ready. Now, what we need to do, what we need to do in the next step, let me leave some space for the efficient frontier. Perhaps can do it here, perhaps, or here. So we need to do, um, we need to simulate the all these portfolios basically. And in order to do this, we have to do this process. So we go to fill series, I believe, and we need columns. And let's say we do 10,000. 1, 2, 3. And the Excel will automatically give us 10,000. And now what we need to do, we just need to take the risk and return that we calculated. So that is it's being automatically generated by the random weights. So the risk is this one, and the return is this one. If it helps, and if it is possible, after the session, I would be more than happy to share the Excel so that you will have both the recording and the Excel to work on and to experiment yourself. So the next step, what we need to do, we need to generate random numbers. So we have to do, if I recall, the what if analysis. So the what if analysis, uh, we have We have to select. So the what if analysis, what we need to do. Just give me 1 minute because I don't do this very often, to be honest. But it's easy to do once once you have the data. So data table, you press on the column, on the column input cell because we are working with columns. And I believe the trick is to just select on the outside. And that is how it populates. So we have the data, and this data changes every time we press F9. You give it some time, and if you take a close look, it changes. Now, the next and final step, what we need to do is to graphically represent the data that we got over here. And that data will be the efficient frontier. So what we need to do, we select the data, we choose a scatter, and we can try to do it more presentable. Recall this shape. It might not be exactly like it because it depends on the types of assets that you have, but you will always have an efficient frontier. So what we can do here, we can start from 12%, perhaps. So we start from 12%. And down here, we start from 4. So the scatter looks nicer. Also, we can change a little bit the marker options. We can do them smaller. So these are 10,000 portfolios, which are investing solely into these 4 assets that we did portfolio optimization for. Now, the next step, we are going to incorporate the individual assets where they stand with the simulated portfolios that we got. And also these two, the maximum Sharpe and minimum volatility, to see whether they are really efficient portfolios, because that's the whole objective of this session. So what we are going to do, we are going to select, we are going to select the data, add, so the X values is this one and the one Y values, and we can label them as well. And these orange ones basically are these individual assets and the two portfolios. but let us format them a little bit to make them more visible. Like this, it clearly shows. So we have two portfolios which are already on the efficient frontier, and we will label them one by one, and we will explain why this is happening. And this is the correct way it should be, because we want portfolios which are on the efficient frontier. So the last part is the labeling. Let's try to label. So this one, 12.19. 12.19 is the S&P 500, which is here. S&P 500, this is 10.35, the Nikkei. 7.88, the Euro Stocks. 5.09, the FTSE. And finally, our two portfolios, which we optimized. This is the minimum volatility, and it makes sense that it's there. Makes sense that it's there because there is no other portfolio which has a minimum volatility than this one. And that's why Excel and Data Solver is very helpful in this case, because it gives you a portfolio according to your needs, basically. This is the minimum volatility. And the maximum Sharpe, although it's not the lowest risk, it's the portfolio which, for the amount of risk it has, there is no other portfolio which is giving you the higher return than it. So the maximum Sharpe is maximizing um, is maximizing on the risk on that set level of risk and giving you the highest return possible. So basically, better higher risk adjusted return than this point is unattainable using these four investments that we chose. I think from my end, the Excel part is done. If you have any questions, let me know. In the meantime, I'm going to proceed with the remaining few slides. So basically the conclusion, the lessons learned. The main lessons is the first lesson is to diversify. Diversification is very important, not to put all your eggs in one basket, not to have concentration risk, because if you have all your money tied in one single asset and something wrong happens, there's a problem within that company, you are likely to lose a lot of your invested capital. The second lesson is the risk return trade off. Basically, you cannot, if you are taking, if you want higher return, you cannot have zero risk essentially. And we can see it, we saw it from here, from the Excel. For example, the S&P, the it has 12% return, but also it has high volatility. Of course, when you do portfolio optimization, you can um, you can reduce the risk and enhance the return. So portfolio optimization helps. But when you have individual assets, let's say, imagine if we had Bitcoin here, if you want higher return, you have higher volatility for sure. Asset correlation matters. Yes, you need assets which do not move in the same direction together, as we said. So if there is a problem in the market and the market goes down, you do not want all assets to decrease in value. Costs matter as well. You have today we can choose from a variety of investments, and ETFs are one of the top investments because they charge very low fees, and that's a very important concept because you might have a good investment, but if you have high fees on your investment, it simply means that a chunk of your returns, the portfolio manager is benefiting. And their point is to simplify your investments. I always like to mention the S&P 500 because it's very simple to invest in. You can find an S&P 500 investment easily. There are a number of companies which provide access to the S&P 500, for example, Vanguard, BlackRock, Franklin Templeton, and others, which provide access to these investments. And also, in case individuals would like to have a portfolio ETF rather than just exposure to stocks, there are ETFs like the Vanguard Life Strategy ETFs, which give immediate access to a multi-asset portfolio. And the point is to optimize investment portfolios to target the highest return possible for a given level of risk. Of course, as we said, a rational investor will always want a portfolio which generates a higher return for the same level of risk. So if you have portfolio A, which has 10% risk, 10% volatility, and portfolio B has also 10% volatility, but portfolio A is generating 20% and portfolio B is generating 10%, of course, you would choose portfolio A. It applies both on the return and on the volatility, as we discussed earlier. Some final thoughts about these three books. These three books, I highly recommend them. If you are interested in learning more about investments, The Little Book of Common Sense Investing by John Bogle. He is the founder of Vanguard. Vanguard were the pioneers of ETFs. So with the help of this guy, today we have low-cost ETFs. This is a very good book. And also these two good books as well, The Simple Path to Wealth and The Automatic Millionaire. I read them all three, and I highly recommend them for beginners, essentially. They are very easy to follow, but the amount of knowledge that they provide and ideas, I highly recommend these three books. That was all from my end. I understand that some parts of the Excel might be complex, perhaps, but as I told you, I'm happy to share the Excel with you, if that is possible. And also you have the recording, but in case you have any questions, feel free to contact us. So we will be very happy to provide you with any clarification, or you might have any other related queries. We are here to answer them.
Thank you. Thank you so much, Desmond. As I said in the beginning of the session, your session is always so enlightening and we get to learn a lot from them. Let me quickly go through some of the questions that our panel, participants have asked. Most of the questions were related to, as we were discussing before the beginning of the session, as to how and which stocks are the most preferred stocks that we should invest in? And I am excluding those kind of questions from this particular forum. But uh, someone asked, what exactly is the basic amount of money that is required for one to begin investing? Is there any specific amount of money?
So basically, it depends on the product. Essentially, there is no minimum investment. But for example, I have a pension. I have a pension plan in Malta where I live because I want to, when I retire,